January 14th, 2026. If you walked into a bank in Seattle, Austin, or Boston this morning and asked for a mortgage on the average starter home, the loan officer, assuming they haven't been replaced by an AI kiosk yet, would hand you a piece of paper with a number that looks like a typo. $7,000 per month for a two-bedroom box with a leaky roof and a commute that destroys your soul. 3 years ago, back in the panic years of 2023 and 2024, everyone was waiting for the crash. We were all refreshing Zillow, waiting for the 2008 sequel. We thought if interest rates stayed high, prices had to come down. That is how gravity works, right? But gravity broke. Instead of a crash, we got something much worse. We got the freeze. You see, in 2026, nobody is selling. Why would they? The baby boomers are clutching their 2.5% mortgages from 2021 like golden tickets. To sell their house and move would mean trading a $3,000 payment for a $7,000 payment on a smaller house. So they stay. They die in those houses. Inventory didn't just dip, it evaporated. And when supply hits zero, price becomes irrelevant. So here we are. The American middle class is split into two distinct species. Species A, the locked in, sitting on millions in equity they can't access. And Species B, the locked out, earning six figures but living like college students, watching their down payment savings get eaten alive by inflation. But while the locked out were doom scrolling, a small group of financial pragmatists stopped trying to fight the Fed. They looked at this broken, frozen dystopian market and realized something crucial. The price to buy a house had detached from reality, but the price to rent that same house? It was actually crashing. This is the story of how the smartest people in the room stopped trying to buy the American dream and started shorting it. Let's look at the spread. In finance, the spread is everything. It's the difference between what something costs and what it yields. In a healthy housing market, let's go back to 2015. The cost to own and the cost to rent were roughly parallel. If buying was $2,000 a month, renting was maybe $1,800. The premium you paid for ownership was small. It was the price of freedom, the price of painting your walls chartreuse if you wanted to. But by 2026, that relationship shattered because institutional investors, Blackstone, Invitation Homes, the big boys, they overbuilt apartments in 2024. They flooded the market with luxury rentals just as the economy softened. So now, in 2026, we have a glut of rentals and a famine of homes for sale. I want you to visualize a specific property. Let's take a condo in Miami. To buy it today, with current rates and insurance premiums that have doubled since the climate reassessments of 2025, you are looking at $6,200 a month. Unrecoverable. Gone. To rent that exact same unit, $3,400. That is a $2,800 monthly spread. That is $33,000 a year. The traditional advice, the stuff your parents tell you at Thanksgiving, says you should stretch. Eat ramen, buy the condo, get on the ladder. But the financial hackers looked at that $33,000 spread and asked a dangerous question. What if the house is actually a liability? If you buy that condo, you are effectively paying the bank $2,800 a month for the privilege of saying you own it. You are paying a 100% markup for pride of ownership. In the stock market, if you pay double what a company is worth, you go broke. In housing, we call it the American dream. Enter rent vesting. It sounds like a buzzword invented by a TikTok guru selling a course, but it's actually an old hedge fund strategy called arbitrage. Here is the play. You accept that you cannot afford to buy in the city where you work. You accept that New York, Los Angeles, and London are now gated communities for the ultra-rich and the grandfathered in. So you rent there. You take advantage of the oversupply. You negotiate. You live in the $4,000 apartment for $2,500 because the landlord is desperate to fill the unit. But you don't spend that $33,000 spread on vacations or a leased BMW. You take that capital and you become a predator in a different pond. You look at markets that the locked-out generation ignores. The Midwest, the Rust Belt, certain pockets of the South where the population is growing but prices haven't gone vertical. You buy a rental property in Ohio or Indiana or Arkansas. You buy a boring, unsexy 3-bedroom house for $250,000. Why? Because in those markets, the spread is inverted. The mortgage is $1,500. The rent is $1,800. You live in a consumption market. You invest in a cash flow market. You are effectively shorting the coastal housing market, betting that the cost of ownership there is too high, and going long on the heartland. Now I know what you're thinking. I can hear the objection screaming in your head. But paying rent is paying someone else's mortgage. It's throwing money away. This is the most successful propaganda campaign in financial history. Let's talk about unrecoverable costs. When you own a home in 2026, here is what you throw away every month. 1. Mortgage interest. With rates at 6.5%, this is huge. 2. Property taxes, which have skyrocketed as cities try to plug budget deficits. 3. Maintenance. Good luck finding a plumber for under $200 an hour in 2026. 4. Insurance. Let's not even get started on Florida or California. 5. HOA fees. None of that builds equity. That is money you set on fire. It is gone forever. In 2026, for most Tier 1 cities, the unrecoverable costs of owning are significantly higher than the cost of renting. The renter actually has lower unrecoverable costs than the owner. The rentvestor exploits this. They treat their primary residence as a service. Like Netflix, you pay for the service of shelter. You want the flexibility to cancel the subscription, move, if your job changes or the neighborhood goes downhill. Meanwhile, your wealth isn't trapped in the drywall of the house you sleep in. It's diversified. It's in a rental property in Tulsa. It's in the S&P 500. It's in Bitcoin. It's liquid. We need to talk about the lock-in effect again, because it's not just about interest rates, it's about mobility. In 2026, the job market is volatile. AI automation is shifting industries overnight. 1 month, you need to be in San Francisco. The next month, the hub moves to Austin. The next month, your job is remote. If you bought that house in 2024, you are stuck. Transaction costs to sell a home are 6% to 10% of the value. If you have to sell in a flat market, you lose your entire down payment just to pay the real estate agents. The homeowner is an oak tree, strong but immobile. If the climate changes, they die. The rentvestor is a tumbleweed. They move where the wind blows. In an economy, this chaotic agility has a premium. The rentvestor pays a monthly fee, rent, for the option to leave. They are buying put options on their own life. I'm making this sound easy. It's not. It's actually a logistical nightmare. When you rentvest, you are taking on 2 sets of headaches. Headache 1, you have a landlord. They can raise your rent. They can sell the building. You have no security of tenure. You can't knock down a wall to build a nursery. You are a guest in your own life. Headache 2, you are a landlord, but you're a long-distance landlord. You own a house in a state you've maybe visited twice. When the toilet breaks in your investment property at 2 a.m., you can't go fix it. You have to pay a property manager. And property managers in 2026 take a 12% cut, eating into your thin margins. And let's be honest about the psychology. It hurts. There is a primal human need to own your territory, to know that no one can kick you out. Rent vesting requires you to suppress that instinct. It requires you to look at your home as a consumption good and your portfolio as a separate entity. It requires you to be a robot about your feelings. So, who wins in 2026? The winner isn't the person with the biggest house. It's the person with the most options. The old American dream was buy the biggest house you can qualify for and wait 30 years. That dream died when the 30-year fixed mortgage hit 7% and stayed there. The new game is asset-light living. Own the cash flow, rent the lifestyle. In a world where liquidity is king and where the housing market has frozen into a block of ice, the only people moving forward are the ones who realize that ownership and shelter don't have to be the same thing. They are playing a different game. And while their friends are house poor, drowning in interest payments, staring at Zestimates that haven't moved in 3 years, the rentvestors are quietly building an empire of little boxes in places nobody talks about at dinner parties. The anomaly of January 2026 wasn't a glitch. It was the signal that the rules had changed. The question is, are you still playing by the old ones?